Everyone, welcome back. It's been quite a while now since we've done the last webinar. I think it was back in March. This is quite an important time for the company. Obviously, Thunderbird has entered production ahead of schedule and on budget. The format will be very similar to last time. If you did join us, there will be a presentation by the Executive Chair, Bruce, and then following that, we will open up to Q&A. Bruce, do you want to take things off to kickstart the presentation?
Great, thanks, Peter, and thanks everyone for joining again. All right, let me make sure this thing is moving. So as Peter said, very important time for the company. We have just started up Thunderbird and we put the quarterly out, so we thought this was a good time to update people with where we are. Slides just a reminder of, let's say the overall strategy of Sheffield. The focus is still on building a portfolio of mineral sands assets, with a focus on assets that will generate cash so we can generate returns for shareholders. What I'll talk about today is, again, as always, mostly about Thunderbird. Our 50% interest in the mine as it is now, not a project. We've started up production, and I'll talk a bit more about that and what's happening next. A reminder, although we won't talk about it today, we do still have the stage 2 expansion in the future at Thunderbird, the South Atlantic option in Brazil, on that project in Brazil, and we continue to look at other opportunities in mineral sands. In terms of Thunderbird itself, as we've said, the build is complete, on time and on budget. On time, we said it would be Q4. Actually, against our own FID timeline, we came in a few weeks early, which is very pleasing. And the chart here is to sort of illustrate the on budget point. Now, what we're showing here is at a series of milestones, what our total expected expenditure for the project was, broken up into sort of, well, and to start with, we only ever had a CapEx plus pre-operating cost combined number, and then financing, and then the sort of working capital cost overrun. So we started back in March of 22 with at the definitive feasibility study, with a total funding requirement of 484 million Australian dollars, of which 361 million was the core CapEx plus pre-startup operating cost. At FID in October last year, that had actually grown slightly to from 361 to 379, but our estimated project financing costs had actually reduced a little bit in the interim, and so we'd ended up with an overall position of still $484 million as the total spend. In February of this year, when we'd done our updated pre-startup operating costs, we actually split that number out, and we said that the capital required for the build was 336 million, 70 million for the pre-startup costs. And then as we've completed the project and this month, effectively the 336 was actually, we've delivered the project as an expected 311 million, which is a very, very pleasing outcome. I guess everyone understands that to actually deliver a project in WA on budget is pretty remarkable, and to actually come in a little bit under, even more pleasing. Our pre-operating cost is very much in line with what we expected. We helped a little bit there by being a few weeks early. Our financing cost has not really changed from expectations, so we still have that $60 million buffer as we stand today. So that is a fully, the 424 million is the fully committed number. That's taking into account all the commitments we've already made. So at startup, we had $60 million effectively free available funding within the joint venture itself, to fund the ramp up. So not only the working capital allowance, but we effectively have most of our cost overrun still unused and still available to us as we go through the ramp up. In terms of some pictures of what we've been doing, the left-hand picture here is the start of the dozer mining operations. That's actually on the sort of first day or so of operation. What you can see is the D11 on top of the ore stockpile, pushing ore down towards what we call the DMU, the dry mining unit. To put that in context, to say that's a D11, which is looking pretty small. The dry mining unit weighs about 400 tons, so it's a pretty big piece of kit. We started pushing. We've been mining it's a startup, so you don't operate 24/7 from day one, but operating relatively continuously since we started up. This was a picture of the initial feed through the rougher spiral. So effectively, the black on the inner edge there is the heavy mineral concentrate, and then the sand tailings outside of that. And then this is a more recent picture of our tailings dam. One of the things we have done is build a large tailings facility. We believe it has capacity for a couple of years at the expected operating rate, which gives us flexibility in our initial mining. And you can see here we've been depositing tailings for quite a few days now, and the beach is forming. So the tailings dam is operating as expected. We're collecting the water and are able to reuse that water in our operations. Final picture, a very recent picture with the process plant in the background, and in the foreground is the stockpile of HMC. To date, we've been operating the wet concentrator, building an HMC stockpile. So what you can see here is that's the stacker, the actual HMC as it's being discharged from the wet concentrator, and then here's the stockpile of heavy mineral concentrate that's being moved with the front end loader in advance of starting up the concentrate upgrade plant, which is this plant here. So that's the next sort of stage of our startup, is to start putting HMC in the cup, which is where we split the heavy mineral concentrate into the three products: the magnetic concentrate, the zircon concentrate, and the paramag concentrate. The expectation is that we will be doing that, relatively soon, building products, product stockpiles on site initially, ahead of moving product to port. In terms of what does it look volumetrically, what we've got here is we haven't done a revised production forecast. We haven't set production targets for the near term, and we don't intend to set production targets until FY25 at the soonest. Given it's a ramp up, it's difficult to do that. What we have got here are the quarterly volumes that were assumed in the 2022 BFS, so the March 22 BFS, which effectively we've carried through FID, etc. So what you can see, first of all, is that there was no production assumed in the economics in 2023. And so we are producing ahead of that. So we obviously will have some numbers in here. And then we were looking at building over the 4 quarters of calendar year 2024, obviously the first 2 quarters being for the financial year, building our mining rate and our production volumes so that sort of cumulatively over the 12 months, we were originally assuming mining about 8.7 million tonnes of ore and 685,000 tonnes of total products. We, at this stage, would expect to be a little bit ahead of that, given that we've started mining relatively early in the current quarter, mining and producing relatively early in the current quarter. We set the target of Q1 24 for first products shipments. We're definitely running well for that. As I said, we'll be making, next step is to make concentrates, build stockpiles and move them to the port. At this stage, we would expect to be in a position to load vessels, make the first shipment probably early in Q1 of 2024. So rather than, perhaps people sometimes say, Q1, what does that mean? April. Actually, for us, it's more like a sort of January type timeframe. So we're certainly very happy that we should be receiving product receiving revenues early in the new year. Just to recap, I mean, I've talked about the funding at the project level. We do have $60 million of free funding capacity available in the joint venture. On top of that, Sheffield ourselves remain fully funded for our foreseeable work program. We had $24 million in the bank at the end of September. That funds us through for our holding cost. It pre-funds the option in Brazil, should we choose to exercise that. The remaining payments plus the exercise of the option for stage 2 to go to 20%. And that we continue to believe the $24 million is sufficient to fund us through to the end of 2025, when we would expect the first cash flows to flow from the joint venture to the shareholders. So 60 million at the project level, but still well funded at the Sheffield level as well. And that is it's a very short presentation today. Really just wanted to cover off where we were in our current in the build and in having built in the startup and what's coming next. But happy to take questions and if people want to learn more about some specific parts of what we've been up to.
Sure. Let's thank you, Bruce. Let's move on to the Q&A section of this. So we've had a few questions come in already, and I've had a few come in through email as well. But we'll start with Philip Matthews. So given interest rates have increased, can you talk about how the increase in interest rates may impact debt finance and cash flows to start with? And also, can you talk about the sale of products in AUD and the positive impact the Australian dollar at 63 cents compared to 75 will have?
Yeah. Well, the first one, in terms of the impact of interest rates on our debt facilities, the NAIF facility is actually, the rate is fixed. It has some step-ups in it that relate to time rather than interest rates. So effectively, the NAIF rate is unimpacted by changes in market rates. So we haven't seen any impact there. That's about half our debt, including the cost overrun facility. The Orion facility is a variable rate instrument. It's a margin over SOFR, which is called the new LIBOR, for want of a better term. That has gone up with interest rates. It had a floor of 2% plus, or SOFR is a minimum of 2%. I think SOFR today is about 4.5 or 5. So we have seen an increase in interest rates on the Orion facility. But certainly we don't see any issues with debt reservice or debt service or repayment at sort of anything, or even at low prices. That's what it's designed for. So we're still quite comfortable with that. Recognize that the Orion facility was combination of interest rate and a royalty, and therefore the interest rate wasn't overly high to start with. In terms of the pricing impact, yes, I mean, there has been some softening in final commodity prices. Zircon, nothing particularly dramatic. Zircon's probably off about 10% on its peak, and is still weakening slightly at the moment, although contract prices have seemed to have been maintained by some of the big players. Spot's a little bit softer. And ilmenite's come off, but it is true that with the Australian dollar going from 75 cents to 63 cents does give us some significant growth in our A dollar margins, and certainly our the A dollar price of our products. Recognizing that our MagCon is fixed, so for 30%, it's just a pure gain on exchange rate. 30% of our revenues, and on the products that will be market priced, zircon con and Paramag, would certainly say at this stage the decline in the Australian dollar is more than offset any decline in expected product pricing.
Good. This one's from Fletcher Kirby. First of all, great result. Well done to you and the team. In terms of payment terms for the zircon cons and for the TI cons to Yansteel, would you be able to touch on that?
Yeah, look, fairly typically, mineral sands is fairly typically, if you're selling CFR, it would be 30 days delivered. If you're selling FOB, effectively, are we selling in Australia or are we selling in China? 30 days if we were selling delivered, 60 days if we are selling on the boat in Australia. So we're looking at about 60 days after loading a vessel before you receive payment. That's a fairly typical sort of contract basis.
Perfect. What is your look through on pricing for your products versus what you outlined in the BFS?
Yeah, that's a good question. I mean, in the BFS assumptions were certainly long-term pricing. We use TZMI prices. They have not changed their long-term real price. It will have gone up. It went up nominally. So effectively it moves up with the change in base year. So still sort of around about a $1,700 a ton long-term price for zircon, around about a $220 or $30 a ton for ilmenite, which is the primary component of the MagCon once it goes to market pricing. Those haven't changed. What probably has changed from the DFS is the near-term shape of the curve has changed a little bit. Prices have come down a little bit. So you've seen effectively the path to get to the long-term price has come off a little bit. But certainly the net effect in Australian dollars, I believe, is still positive because we've seen, those changes in the shape of the curve are pretty minor compared to the changes in the Australian dollar.
Okay. And in regard to offtakes, one, are there price ceiling mechanisms in place? And how frequent are price negotiations with the offtake partners?
Yeah, so the only component where we have any sort of the MagCon is fixed price with Yan Steel. It's fixed dollars per ton of titanium dioxide. So it does vary a little bit with the product quality, but it doesn't vary with market. The zircon con, where we have contracts, the three contracts we have that cover 75% of the volume, they are market price. There's no cap, there's no floor, so they are whatever the price is. Typically, the price would be negotiated on a long-term. Those are 5-year take-or-pay contracts. Those prices would tend to be set quarterly. If you're selling spot, then you would, can even be pricing shipment by shipment. But our contracted volumes would typically be a quarterly price.
Perfect. The next one is more around commissioning and I guess the risk around it. So obviously it appears that mining's going well at the moment. You've got stockpiles building in the photos. To what extent is the commissioning or has the commissioning been de-risked on the mining side? And would you agree that it's going well and perhaps better than expected?
Look, I think I always say to people, I mean, a startup, it's not an event, it's a process. You're sequentially starting up a lot of equipment, and there's no such thing as a startup where every piece of equipment, you just turn it on and it runs the way you expect. You will always have, minor equipment failures. You'll have things where you go, actually, that configuration isn't quite right. We need to adjust, I don't know, chute position or something. So we're having all of those normal things in a startup. I would say today the startup is going very well. We certainly haven't seen anything that I would say is out of the ordinary for a startup. I mean, I'm obviously sensitive to the fact that there have been some difficult startups recently in Australia and in wider than just in mineral sands. I mean, I think there have been issues with a number of operations. We have done a number of things to what we believe de-risks our ramp up compared to some others. I mentioned one as we went through the presentation. We built a very large tailings dam, and what that does is it allows tailings deposition is effectively delinked from the mining. We're not trying to put the ore back in the hole we're creating. What that does is it gives us flexibility to learn to mine and get the mine running well without also having to worry about in-pit tailings disposal. So we've got a couple of years of that. Now, we will go in pit as soon as we can, because it is ultimately it's better. It makes rehab easier. It's better from a cost perspective. But in the near term, it gives us that flexibility. So we would not expect tailings constraints to impact on our ability to mine, because we've delinked them. We are making concentrates, and that does help, because you're effectively making products that aren't sold against a hard spec. Certainly the HMC so far is looking very good, and we're very happy with what's happening there. The next step is to make the cons, but it's a relatively simple magnetic separation. So I would not expect us to have any great difficulties making the products. It's all about, again, starting that piece of kit up, getting it running. And then there's a big optimization piece here. The ramp up is over an extended period. I mean, if you looked at that chart I showed before, you're talking about building up to full throughput, full productivity over an extended period of time. And I would expect that to be the case. So very happy with what's happened so far, but also very realistic that, we're in week 2 of operations. So there's a lot of things to happen before we say that we're fully ramped up and a steady state operator.
Perfect. I'm just going to switch to one that we had an email come in for during the session. And it was actually to do with slimes, and they've sort of noted that quite a few projects have been held up by the presence of slimes in their processing. Is that something that you're anticipating with Thunderbird?
Well, no. Look, what we would say is our plant, it's all about what have you designed for. So there's 2 things for us. One is our slimes effectively is referring to material typically less than 38 microns. Now, in many operations, those slimes are actually clays, which means they have colloidal type properties. It means they will react with water. They can create coatings on minerals and things like that. So what we have, our fine material is actually sand. So it doesn't have those sorts of properties. It really is fine sand rather than a traditional slime. Certainly what we're seeing at the moment is we're having no difficulty removing the slimes. The HMC is slime free. The slimes are going to the tailings dam. We're removing oversize in the pit as well as at the wet concentrator. That's a large part of what we do, is remove slimes and oversize to get to the core sand fraction. And given the magnetic separation we're doing, it's a wet magnetic separation, and we don't have sort of clay slimes. I don't anticipate any slimes issues related to separating the concentrates out.
Perfect. The next one I think is just a question on pricing. Is the MagCon fixed at US $130 per ton FOB?
Yeah, it's slightly complicated. It's fixed at $1 per percent titanium dioxide, and that $1 per percent is higher if the quality is higher and lower if it's lower, and there is a penalty element related to silica. So effectively the price does vary depending on the particular quality of each shipment in terms of titanium dioxide and silica content. What we've done, we assume the price, I mean, it averages out. So what we're anticipating is over the first 5 years, that average price based on what we know of the ore body and the expected product quality is $123 a ton of MagCon on average over the first 5 years, which is the fixed price period.
Given issues with production at Strandline and recent announcement of closure at Base's project, Quale, in 2024, does this result, in your view, in a stronger market for pricing next year?
I mean, I think, next year, Base is going to operate next year. Look, I don't think the closure of Quale comes as a huge surprise to the market, or to the industry, I should say, to the product markets. It was built in to sort of industry forecasts of supply and demand. And that would be more of an ilmenite rutile impact, not so much zircon produced there. Strandline, it obviously it hasn't run as well as expected so far, which means there's been less zircon available from that project. Time will tell. How long it takes to fix those problems. It's not a particularly large supply of zircon. So, and I think the actions of the leading players in terms of adjusting their supply to demand. We've seen Tronox talking about adjusting their feedstock production to align with the demand for titanium dioxide, and as a consequence of that, reducing their zircon production. And we've seen Iluka adjusting their zircon sales. Those are far bigger impacts in the market than particularly in the zircon market, than either Strandline or base would be, particularly in the case of base, since it was expected anyway.
Awesome. Has the ore induration been an issue to date?
No, I mean, a lot of these things are, if you know they're there, you design for them. I mean, we always knew this would be it's quite an old deposit. It does have induration. It does have, particularly the overburden is quite rocky. So that's why we did the really large mining trial. Although I thought it was large until we opened the pit up for operation, and then you realise it looks quite small compared to that. But that helped us learn a lot. So we certainly we have induration. We knew that, but we have the equipment there to deal with it. So we can rip indurated layers with the D11s. The MUP, or the DMU, the dry mining unit, is designed to remove that oversize. It's working well. So the oversize is screened out at we've got grizzlies and screens on the DMU to take the blocky material out. It's not valuable. So we haven't seen any, it's what we'd expected. We have some induration. We're able to handle that as we're mining.
Just a clarification question in terms of the MagCon fixed price component to Yansteel. Did you say that was just for 30% of the MagCon production? No,
it's 100% of the MagCon production. That represents 30% of our revenue.
Perfect. I've just had two questions come in, and then I think we'll move to Brazil because Chris has asked a question on that as well. But I think you've potentially answered a little bit of this, but it's one of the questions that's come in have said it's early days, but how is the ore body looking and behaving at the front end?
Yeah, look, it's fair to say it's early days, and a lot of it, I said before, our DMU, so our mining was about can we handle the indurations, etc. And so far the indication is fine. We've done a decent amount of waste mining. We've mined it. We were mining. We had to open up the hole to put the DMU in, so effectively we pre-positioned an ore stockpile, and in that we got confidence around our ability to mine. So certainly from a mining perspective, as within the range expected. In terms of the front end and is it performing, I mean the purpose of the DMU and the wet concentrate, I mean effectively a large part for us is removal of oversize, removal of undersize, and so at the moment that's looking pretty good. We're definitely getting the oversize out in the pit. We're getting the undersize out in the wet concentrator. But early days, we have not optimized our circuits yet. It does take quite a. We have a 7-stage wet concentrator that will take. There'll be a bit of an exercise over time of working out the optimal way to operate that, because it's a trade-off between throughput and yield, particularly for us, less so recoveries and product quality, because we're not overly constrained by product quality, but getting the optimizing the yield to make sure that you're maximizing the yield of valuable products and throughput is really going to be the exercise over the next sort of 6 to 12 months.
Yeah, perfect. Any initial thoughts on the grade reconciliation against the reserves at Thunderbird?
Oh, it's far too early to comment on that.
Okay. And moving on to Brazil, obviously it looks to be a fantastic project. Do you see any showstoppers?
No, look, I think for those that have followed the story, we like the project technically. We are going to be drilling starting later this quarter, and we're in preparing for a PFS. So certainly we expect certainly by the time we have to decide on the option, sort of around about the middle of next year, we would expect to have a resource. We're looking to convert the exploration target to resource with the drilling program and have a PFS, which will give us confidence on the economics. We're doing some test work at the moment on Bouguereau to see if it behaves the same way as Retiro. We expect it will, and that'll give us some information, or at least information that we can rely on in a JORC sense, or that's exchange compliant around product quality, etc. But all indications from a technical perspective is the project is what we thought it was. For those who follow this, the reason why we had the option was to get comfortable with Brazil, and a lot of that was around our confidence around the approvals and how that process goes. Now we had that. There was the issue of the mining ban that was overturned as unconstitutional earlier this year. No attempt to reinstate that. A recognition that authority doesn't rest with the local bodies. And we're seeing good progress on engagement from IBAMA, who's the national regulator for the environmental permits. We have the primary permit. It's called an LP. We need what's called an LI, an installation license, is the next step, and that triggers the granting of the mining decree. It's effectively a mining permit. That review process for the LI is underway, and we're certainly seeing. And we expect that the LI will have been granted prior to the time when we need to exercise the option, which will be a key indication to us that you can in fact permit to move a project forward. I mean, I think the thing I would always say, as well as Brazil, is it's a very significant resource destination. You have oil and gas, you have mining, you have agribusiness. Actually a very good track record of permitting and so on. So we just want to see confirmation of that. And we're in a different part of Brazil from the main mining areas for iron ore. So we just want to see that works down in the southeast where we are. But overall, we've got no concerns about what we've seen so far.
Brilliant. That's the end of the questions. But Bruce, I'm just going to give it back to you and just. Perhaps it's worth you just explaining the roadmap over the next couple of months to first revenue and any final thoughts that you might have.
Yeah, I mean, I think thanks, Peter. Yeah, I mean, where we are today, as I said, we now what we'll be doing, we'll be starting up the cup, making concentrates, building those product stockpiles, and then moving them to port, positioning product at port ready for shipment. As I said, we expect the first shipment to be early in Q1 2024, so early next year. Very much on track for that. That's probably our next big milestone. We're not planning on giving a blow-by-blow of everything we do. We'll provide updates if we think it's appropriate, but if you don't hear otherwise, we're on track. We're continuing to progress. Then first shipment in early in Q1. Therefore, based on what I said before, we're expecting sort of revenues to be received in probably late in Q1, given a couple of month sort of working capital cycle. So we anticipate peak debt draw in Q1, late Q1, and then Q2 we would expect. The way I've sort of got people to think about it is this quarter is all cost. We're operating, but we're not actually shipping yet. Next quarter is probably a bit of a wash. We've got cost, plus we'll start to receive revenues. We would expect Q2 of the calendar year 24 to be the first period where we're both, we've got the costs and the revenues, and we would expect to be cash flow positive in Q2. So we'd sort of see our way through that by Q2 next year, we're cash flow positive at the asset level, and therefore no longer drawing down on our facilities to fund the operations.
Brilliant. There has actually been one last question, so we'll quickly touch on that, and then we'll wrap up. What are the titanium grades at Brazilian within the Brazilian ilmenite?
The titanium itself, we're expecting the ilmenite to be good quality, sort of sulfate ilmenite, suitable for sulfate pigment and potentially for making chloride slag as well. It's probably going to be about a 51% titanium dioxide ilmenite. It has acceptable impurities for both sides. So yeah, it's a fairly standard sort of just over 50% ilmenite product.
Perfect. Well, we'll wrap it up there. I think that's the end of the questions this time. But there are contact details on the Sheffield website. If anyone has any further questions, I'm sure the team would welcome a reach out. We'll also be releasing the recording of this in case anyone needs to see it. So maybe keep an eye out for that within the next sort of 24, 48 hours. But Bruce, thank you for your time, and thank you everyone for joining.
Thank you.